Good morning. I want to welcome you to this morning class, and my name still remains Barry George, and I'm taking you on the advanced monetary economy. That's what I'm taking you. I want to know more about money economics, and we say that monetary economy is one of the branches of economics study in the field of macroeconomics, and also the monetary economy studies how money and monetary institution functions and affect also broad economic aggregates such as price, employment, output, uh, and also the balance. Also, just to mention few of them. So the unit starts with a discussion on scope and the importance of money. So we're looking at the scope of money, and we say monetary economy is that branch of economy dealing with money and monetary relationship in the economy. It studies the different competing theories of money, and also it provides a framework for monetary analysis, and it's also linked to macroeconomics and also monetary economics. Examines the effect of money system, including regulation and also the associated financial institution and international aspect. IAO 1993 opined that the associated financial institution and international aspect uh, also both domestic and the monetary relationship and international monetary relationship. So the essentially the domestic covers areas such as the origin, growth, and evolution of money, and also its kinds, the money supply, money demand, monetary institutions such as deposit money, bank investment, also development, and also central banking, the effect of money on the working of the economy, such as price, as put, and employment, also balance of payment. So interest rate, capital market, credit creation, monetary transaction mechanism, also monetary theories and monetary policies, and it's also influence on the economic activities. And also we're looking at the international economy relates to the role of money in international transactions and exchange of goods and services. So they primarily are focused on the monetary standards. So in international financial markets, international financial institution, foreign exchange rate, reserves, and also international liquidity. We're looking at the importance of monetary economy. One, monetary economics examines the role of money in the economic administration and the use of scarce resources. And so it permits an understanding of how the monetary section affects the overall also allocation of resources and also the aggregate performance of the money of the economy. Such aggregate performance entails the determination of total level of output, income, employment, and price in the economy. So, two, we're looking at the knowledge of the monetary process, also has some also decrease of relevance to the economic position of the decision maker. So it impacts knowledge to improve that the effectiveness of monetary process in the economy. So since the entire function of the economy is also initially affected by the stock and flows of money, we have to understand the nature, scope, and implication of such effect. Then we move on to the third one and say it could also be a source of making a living for professionals of monetary economics through employment in social, political, and also economic institutions, especially financial institutions like banks and the stock market. In fact, the study of monetary economy is quite relevant to the public policy formulation and also implementation. Are we looking at the nature and definition of money? We say money as well as also known today, money as well known today, is as a result of a long process. Initially, people engaged in barter because there was no money. Barter is the exchange in merchandise for merchandise, and also metals 2018. This means that trade was done on the basis of direct exchange of goods and services. So, for instance, a cow can be exchanged for a goat or horse in types of this type. So, a barter economy is simply an money-less economy because people produce for consumption or for exchange for goods, and they also want. And also the ancient civilization, cowries also served as medium of exchange. So there has been controversy over the meaning of money. According to Steve Vai, and it says, as cited in Jinga 2011-7, money is a difficult concept to define, partly because of the fulfill not one but three function: A, unit of account; B, medium of exchange; and a store of value. So we're looking at the Professor Johnson, 1962, has cited, identified the definition of money, four main schools of thought, and they are discussed here. The first is the traditional definition of money. According to the traditional view, money is defined as accuracy and demand deposit, with also the importance function to act also as medium as exchange. So economists such as Keynes and Hikes also follow the traditional view and define money as a unit of account or measure of value, and also as a means of a payment, as a store of value. So the banking school criticized the traditional view of money as arbitrarily because there are other assets which are also equally accepted as medium of say exchange, such as the includes the time deposit money by, and also commercial bills of recharge. Two, Friedman's definition of money. Friedman and other monetaries uh, define money as the literally the number of dollars people are carrying around in their pockets. So the quantity of dollars in their bank in form of demand deposit, also commercial bonds, time deposit. This definition was criticized as being narrow because cash and deposit money were also not comparable over a long period. So Friedman later gave a broad definition of money to include bank drafts, bank deposits, non-bank deposits, and any other assets through which monetary authorities influence future income and also employment, prices, and other macro variables. Then three, we look at the Radcliffe redefinition of money. Radcliffe also committed define money as note plus bank deposit. By this definition, only assets also commonly used as media of exchange were also included as much. So assets refer to liquid asset, by which it means the monetary quantity influence total effective also demand for goods and services. So Jingan 2011, this is interpreted to include credit, but the the spending decision does not depend on cases or money also in the bank. It's also based on money deposit. People thinking they can get by selling an asset or by borrowing or by receipt from sales. Then four, the godly show definition. Godly and show formulate a wider definition of money based upon liquidity, which include bond, savings, and loan, also insurance services, and also pension fund. So by this definition, they regard a substantial volume of liquid assets held by financial intermediaries and liabilities of non-bank intermediaries as close substance for also money. So they believe in the velocity of money as stock that is also influenced by non-bank intermediaries. So from the above, we have also seen that scholars define money as a means of valuation, and of payment, and both units of account and also general lay acceptable medium of exchange. So the definition is widely because it captures money to include gold, checks, banks, drafts, currency, note, and coins. So scholars such as Head 1967 cited in Metu 2018 define money based on functions it's performed by defining money as what money does. As whole scholar define money based on legal terms as anything which the state also declare as also money. So that means that money is generally acceptable and has the power to accept in exchange for debt, though some people also may accept something not legally defined as money in exchange for debt, but may not accept legal money by also the refusing to sell goods and services against payment of legal tender money. So example of such thing are checks and notes also issued by deposit money bank aside legality, and there are also other determinants of what constitute money. And so looking at we also adopt CBN 2016 definition of money as anything of value that's acceptable by the general public for the purpose of making transaction and settlement of debt. So the definition shows that money is used primarily as a means of exchange and plays an important role in the settlement of financial obligation. And most time also the people regard money as currency, coins, note because it is easily used in making payment. However, money is more than currency because it includes other things that are used for currency. So looking at the functions of money, and we say the following are major functions of money and also classified into primary and secondary functions. So the functions are, we have the primary functions of money. The primary functions of money we have first is the use as a medium of exchange that is used for goods and services, used for money facilitate exchange by acting intermediate and making it possible for people to exchange goods or services through trade. And B, units account as a measure of value. We see it as it creates a worth. When we talk about value, we're talking about the word money serve as common unit and also relatively value for goods and services, such as the kilometer is used to measure temperature. So money is common denominator, which also determine the rate of exchange between goods and also services. So money is used expressly the value of common commodity in terms of prices according to the Robertson as cited in Matthew 2018. Price would also terms of money becomes the focus of also people's behavior plan and also the expectation and contract focus on money price. B, we saw secondary functions of money. Money performs the secondary function, and one of them is the store of value. Money makes it possible to save now for later use. For instance, money can be used also instant perishable goods from farmers cannot be stored. So money can be used as a store of value in meant of a unforeseen emergency and also for the payment of debt. And so the according to Keynes, to also hold money is to keep it as a reserve of liquid asset, which can also be converted into real goods, but the store of value functions of money also suffer from changes in the value of money. Two, as a standard of deferred payment. Deferred payment means settlement of debt at a late date. All debts are taken in money. Money facilitates borrowed from banks and other non-bank financial. It also facilitates future contracts for the supply of goods for agreed also payment of money. So by acting as a standard of deferred payment, money helps in capital also formation both by business and also the government. So number three, we say money as a transfer of value, as money is generally acceptable as means of payment and act as a store of value. It keeps on also transferring values also from one person to another and from one place to a place. So sometimes holding money in also cash or assets can transfer same to some other person. So the person may also even decide to sell the asset in one location and also relocate to another location and also buy another asset in new location. So the function of money facilitates the transfer of value between persons and place. Then C, other functions of money. Money perform other functions such as money is the basis of the credit facility. Yes, that means to get a credit facility, we would need money for that. Then two, money is the basis of the credit facility. Two, helps in decision making. Well, your consideration for everything is based on money. So if you're going to have consideration and you don't have money, then consideration is not effective. Three, money serves as a basis for adjustment. In case people with money, with very money, can adjust to a situation. So monetary economics, one of the specialized branches of economy, as we have seen it. Then we're moving on to the money demand and determinant. Also, we're looking at the general demand and supply framework is fundamental to study of economics, so theories and analysis. So demand for money arises from a function as a medium of exchange and a sub value. Hence, individual, household, and firm wish to hold money partly in cash and also partly in form of fixed asset. And so, in this unit, we're discussing some of the demand for money. And so, we're looking at theories of money. In monetary economics, demand for money refers to the desired holding of financial assets in the form of money. That is, bank deposit or cash rather than investment. Matthew 20:18, the means total amount of money balance. So also that people want to hold for a certain purpose. Demand for money is narrowly defined as MI, that is spending holdings, or grant also money, which is M2 or M3. M for M1 is necessary for transaction. That is, they provide liquidity. MI can be divided into transaction motives and also precautionary motives. So two is brand money, that yes, a non-trivial trivial interest rate based on the asset demand. So nominal also money balance, MD and also O are also mentioned in monetary unit. Y also real money balance, that's MDO over PO, are also measured in terms of purchase uh, of power of the quality of money demanded. So Anyang and Okina also have a demand for money arise from two important functions of money. First is money, such as medium of exchange, and also second as a store of value. So those individual business which are also hold money partly in cash and partly in form of assets. So there are two views to exchange and demand for money. The first is scale view, which is related to impact on the income. And the second is directly related to the level of income. So the second is the substitution view, which is also related to the relative attractiveness of assets that can be also substituted for also money. For instance, when interest rate on alternative assets such as securities and bond rises. So it makes the assets more also attractive, and also the people will prefer to invest in them instead of keeping their assets in cash. So leads to a decrease in the demand for money, but when the interest rate fall, their asset becomes less attractive and people will hold their asset in case also cash, leading to increase in the demand for money. So the scale and substitution view are also used to explain demand for money, which Keynes split into transaction, precautionary, and also speculatory demand for money. So we're looking at the Keynes also liquid preference also approach. So demand for money is determined by the behavior of economic agent, especially by the household of firms. So Keynes, in his general theory, used neutral liquidity preference for the demand for money. So Keynes, as cited in CBN 2015, highlights three motives for the demand for money, namely the transactional, precautionary, and also the speculative motive. So the transactions demand for money as a medium of exchange. Money is held for the regular payment for goods and also services. This means that money is held in cash for immediate transaction of business and also personal exchange. So it is held of the synchronization of period of income, also receipt and disbursement, which is also determined directly by level of income. So money demand is further divided into income and also business motives. So the income motive is also meant for the internal between income receipts and disbursement, while the business motive is to bridge the gap between incurring business costs and also receipts from business proceeds. And if the gaps between receipt of income and incurring expenses in most, also people will also hold more cash for current transaction and via vice versa. So transactional demand for money depends upon the level of income, business turnover, interest rates, and period between receipt and disbursement of income. Hence, traditions demand for income is also directly related to income and also expressed as Li is equals to Ky in equation 1. And so where Li is the transactional demand for money, K is the proportion of income get and transactional purpose, and Y is the income. So 2, the precautionary demand for money, and also this is the provision to cater for emergencies and contingency or to provide for unexpected expectation. Individual reserve cash for unexpected needs, but as a illness and accident and other also uniform circumstances. So business also keep cash in reserve to take care of unfavorable condition or to gain from expectation or unexpected deals. According to Keynes, the precautionary demand for money is function of income level, although post Keynes argued that it is inversely related to high interest rate. And precautionary demand for money depends upon the level of income, business activities, availability of cash, then the cost of the asset and opportunities for unexpected profitable deals. So precautionary demand for money is also expressed as a LT is equals to function of Y and R in bracket. Then we also look at the speculative demand for money. Money held for speculation purpose is a liquid store of value for investment in an interest, also bearing securities or bond. After keeping fund for both transactional and pecuniary purpose, individuals and business keep fund for investing in bond so as to make also speculation gain when opportunities also rise. So speculative demand for money is also inversely related to interest rate. So the higher the rate of interest, the lower the money will be demanded for speculatively also purpose and vice versa. So according to Keynes, money demanded for transaction and also peculiar precautionary also purpose is primarily function of the level of income, which is LR is equals to the function of Y, and also the speculation demand for money is a function of interest rate, that is the function LS is equals to the function of R, and therefore the total demand for money is also a function of both the income and also the interest rate. So we have the LR plus the LS function of Y to plus the function of rate. Then the L is equals to function of income and also of rate. So YL represents the total demand for money, and also can also define the determinant of demand for money as the level of income, interest rate, price level, and also the return on bonds and also equity. And we moving on to the Friedman theory of demand for money. So Milton Friedman improves on Keynes' liquidity preference theory by treating money like any other asset. He posits that the individual hold money for the services it provides to them in form of also general purchases power to that, so that can be also conveniently and buy goods and services. So Fred and Mann also consider the demand for money merely as an application of a general theory of demand for capital asset in also contrast to transactions and also speculation demand for money. So Friedman theory is based on the premises that demand for money is affected by same factors as demand for any other asset. So individual can hold their wealth in form of money. So bond, equity, and real estate, for example, cars, houses, and land that also money yield returns and provide services just like other capital assets. So the various factors that determine demand for money was also used to derive demand for money function. So the equity share is another form of asset, also asset that's being used for which is wealth can be held. The yield from equity is determined by the dividend rate, expected capital gain or loss, and expected exchange in the price level. So bond, another type of asset in which the people can hold their wealth. Bonds are securities which yield a streams of interest income fixed in normal also time. So yield on bond is the coupon rate of interest and also the anticipated capital gain or loss due to the expected changes in the market rate of interest. So Jane 2011. The fourth form in which people also hold their wealth is the stock of producers and also derivative durable consumer commodities. Although these commodities yield also streams of income in also kind rather than in money. So thus the basics yield from commodities are also implicit one. However, Friedman also consider an expected yield from a commodity in the form of expected rate of exchange in the price per unit of time. So Friedman and nominal also demand function MD for money can be also expressed in MD, that is the nominal or demand for money. That's a function of W, H, R, M, R, B, R, A, P, A, P over P, and I, and U, where MD means for nominal demand for money, and W stand for wealth at all individual, H for the also proportion of human wealth to the theta, and also R is the rate of return or interest on demand. RB stands for the rate of interest on bond. RE is the rate of returns on equity. P is the price level. A change in P all over P is the change in price level, rate of inflation, and U is the institutional factor. So Friedman concludes that the economic agent want to also want to hold a certain quantity of rate as with opportunity nominal also opposed to nominal money balance. Real money balances is also nominal money divided by the price level. Hence, demand for real money also balance can be expressed as the M demand for nominal money over the price. So it's a function of WH, RM, RB, REP, then change in price over the price, then or U, where we have MD is the demand for real money balance and other variable are initially explained, and the non-existence also of also the data above the value of money W, which makes it difficult to estimate the demand for money using Friedman demand for money function to also overcome these difficulties. Also, Friedman suggests that since the present value of money, or W is equals to Y over P over R, where YP is the permanent income and R is the rate of interest or money. And so permanent income YP can be also used as proxy variable for the wealth. And informing this is Friedman demand for money function, it becomes MT is equals to YP HRM RD RE, change in price over price, and then U. And so if we look at that, now I'm going to stop here and I'm going to look at other areas right now. I will go for the